All right. Well, thanks, Olivia. Thanks, Brett, Amy, and Linda for sharing the research. It's a real pleasure to have this opportunity to discuss these important papers. I think they provide a really useful both historical perspective and then deep dive into some of the data and issue. And I'm just going to try to set up what I hope will be a productive dialogue and discussion. Let me start just by recapping a little bit what I heard and what I read. First, from Brett and Amy, they provide a great overview of more than a century-long history that's led up to the ESG movement today. And I think that's really important. There have been a couple other papers by Bob Eccles and others that have looked at maybe what they call the modern era, the last 50 years. But it's great to trace that back and link it back to theories of externalities, understand the importance of concentrated ownership in driving change, the tension between stakeholder and shareholder theory, different ESG factors and the weights and importance they've had at different time periods in different countries, and then touching on the data points that are so central to Linda's paper. And then the paper closes, I don't think they got to this in the presentation, with some real important questions about, as we start mainstreaming ESG and coming into this being something that might be of interest to broad universal owners and pensions, can this heterogeneity survive? Do we need more consistency, more alignment in terms of what we mean, what the motives are, who the players are, what the data is? And I think there's some real open questions there going forward about whether so many flowers, so many voices can still bloom when we're trying to take this into pensions in major countries, or whether we need more consistency. In particular, the data issue is really prominent, and Linda's paper focused really heavily on that. And there's been a lot of discussion, and we have one of the authors of the paper, the aggregate confusion paper, presenting later in the conference. A lot of concerns about why the ESG data don't align, why they disagree. Is Facebook an ESG friendly company or not? What about how do we view the ESG performance of different companies, and why do the ratings differ so much? And Linda helpfully points out that one of the reasons is the data were meant to measure different things. They measure from different sources. They use different imputation mechanisms. And then she highlights some of the performance benefits of the MSCI rating, which is one of the data feeds that they provide, using their proprietary dynamic industry-specific weighting, and show that for different outcomes, different weights with different industry-specific weightings over different time horizons have predictive power. And I'm going to come back to that a little bit as one of, I think, the problems if we want to take this into the broad-based pension space. So what's behind both of these papers? Depending on what you pick up, there's somewhere between a few trillion and $30 to $40 trillion of assets under management that say they want to pay attention to ESG factors. That's astounding, and it could be revolutionary. It can help us deal with things like climate risk, racial justice, social justice, and other issues. But there's a nagging sense that we may have gotten ahead of ourselves, that maybe this is a hype, maybe this is a fad that's ahead of the reality. Maybe there really aren't $30 to $40 trillion of assets chasing ESG, and maybe they're confused. And some of that confusion relates to what they actually mean by ESG. Do they mean values, or do they mean value? Are they investing for higher returns? Are they investing according to some social or environmental outcome? How do we measure that? Do we rely on the companies to tell us, either in their sustainability reports, which are unaudited, or in their response to surveys, which are proprietary? Or do we look to what stakeholders tell us in the media, or what the satellites tell us, or some other data source? And what do we do when we don't have a data point that we want? How do we impute that? Where do we get do we just do mean imputation? As data science evolves and big data techniques evolve, it becomes critical because, not surprisingly, like ExxonMobil didn't release its Scope 3 emissions until earlier this year when they were pressured by an activist, engine number one. That's not random. That choice of disclosure occurred at that moment for a specific reason. Then when we start looking at the correlations, institutional investors and pensions in particular want to know, are they sacrificing value? Are they risking their fiduciary duty? Or are they actually potentially driving value? And the answer to that question is far from conclusive. The reason is, when the academics start looking at this, they come to somewhat dated analyses and dated answers, partly because they're using the wrong data. The primary data source in the vast majority of academic studies is the MSCI KLD data, not the rating data that Linda showcased, because that's what is provided free to us in academia. And we have a little bit of a path dependence to rely on what previous academic studies have used, especially if it's free. But that creates real problems because we're not using the MSCI ratings or the other data sources that Linda was talking about. And when we start analyzing them, we don't get the same degree of support that Linda's showcasing. Should we be measuring values or value? The KLD data measures values, not value. Should we be relying on voluntary corporate reporting? KLD does. Maybe we should be using alternative data as Linda suggested. Even the data that uses the studies that use the best available data are not convincing the skeptics. Why? The time horizons aren't long enough. The assumptions aren't clear. The processes aren't transparent. And so we need to make real progress, and we need to understand the history. We need to have good data, but we also need to make progress from where we are if we're going to mainstream this. So to put both papers in context, yes, there is a diverse and dynamic history of meanings, motives, and players, but I would cut it a little differently. There's a set of investors who have their origins in religiously motivated screening by Quakers or by others. They focus on values. It turns out that that also offered some benefits in terms of risk mitigation at minimal cost with respect to tracking error. But then when the academics started saying, well, does that have impact? Are they really investing according to their values and having an impact on outcomes? The models that look at whether divestment actually changes behavior of companies show that it only occurs under the rarest and most select conditions. I mean, we can point to South Africa, but even that case is contested. So it's not clear that screening firms out and not investing is actually changing the outcomes we care about when we do the rigorous academic research. Then there was a second wave of investing, which focused on engaging with companies, CalSTRS, the New York City Pensions, UNPRI, and this actually works. It drives change in companies and it drives value. And we have rigorous academic studies which back that up. That's fantastic, but it's expensive. It's expensive in terms of fees, and I'll come back to why that's a problem in a minute. Then there are new quant-based strategies that focus on portfolio optimization, tilting, and factor models. They're heavily data reliant. And that's going to bring me back to the data problems that Linda started talking to us about. So what holds us back? What's needed if we're going to make real progress? One of the things that's holding us back is we're in an era that's disposed against high fees. There's an industry-wide pressure for low fees, which privileges the simple strategies of exclusion and the simple extensions of existing strategies using off-the-shelf data. Let me show you how big of a problem this is. The average, the data I'm showing you here is the average for all 425 ESG mutual funds and ETFs that are so identified by Morningstar. The average fees are trending down, both among the mutual funds and the ETFs, both unweighted and weighted by assets under management. That's true overall, and it's true relative to benchmark. It's also true that as we start squeezing the fees, we start seeing lower active share, which means these portfolios don't look so different from their benchmarks. The ESG funds are starting to look more and more like the benchmark funds because we're squeezing the fees out of them. The thing that's gaining is the thing that doesn't work. The thing that's gaining market share in terms of the share of assets under management to ESG funds is funds that pursue exclusionary strategies, not engagement. Again, because that's where the low fees can survive. The share of ESG assets under management that goes into the low fee funds continues to grow. That's really problematic if we want to pursue engagement, if we want to pursue strategies that really work. And the explosion of assets under management, it's often reported 2020 was a great year for ESG funds, but it's all going into low fee ETFs, which are the closest to the benchmark funds in terms of their portfolio composition and doing the least engagement and having the least impact. So that's one problem. The second problem is that institutional investors remain hesitant as to whether ESG investing is worth it. If you go to the Callan Group, which has been surveying institutional investors since 2016 about their perspective on ESG investing, why aren't you incorporating ESG factors? The number of 1 minute. Okay, institutional investors who aren't doing it remains high. The punchline is the reason is they don't believe there's a return, and they're right. The average ESG fund is not overperforming its benchmark. It's overperforming on ESG, but not on financial performance. Then we've got the data problem. Some of the data was designed to capture values. Some of it was designed to capture value. How do we improve model fit? What we need is third-party validation of proprietary data. We need to prove or test whether ESG investments pay and when they pay. When do they impact growth? When do they impact cost reductions, productivity uplift, and the idiosyncratic or systemic risks? What are the contingencies that drive that? Investor demand, asset manager incentives, stakeholder interest, the availability of technological options, anti-competitive barriers in the industry, corporate enterprise risk management. All these things should moderate the effects, but we need a way to test the proprietary data, to examine the assumptions, not to take them for granted. For example, the widely cited piece by Serafine and Cohn and Yoon that tests and shows the proof of materiality, when we explore all the different assumptions they make, the results that materiality matters are true for only a small percentage of all the possible choices in that paper. We need to undertake this kind of rigorous assumption using model uncertainty analysis of all the ESG studies. And the place to do it is in partnership with the ESG Analytics Lab at Wharton. What we're trying to do is leverage our demonstrated expertise in analytics to develop high-quality, replicable academic research and pedagogy, resulting in insights that can help you, that can help institutional investors, asset managers who care about ESG, but to do it in a transparent way that is replicable, rigorous, and subject, and will convince the skeptics as to whether there really is a there behind ESG. Thanks very much.